Excellent. Right, well, thank you very much, everybody, for joining. My name is Neil. I'm a partner in our insurance team, and I'm based in the Manchester office. Although, as you can see, I'm at home at the moment, as I suspect most of you are, and will be for a little while yet. We're very grateful that you're joining. This is the next in our series of Mills and Reeve Cover Talk webinars, which we hope that you've been enjoying. This week's webinar is on the subject of aggregation in insurance contracts. If you'd like to see any of the earlier webinars, then you can do so by going to the website, www.mills-reeve.com. If you click on Insights at the top and then go to the webinar button, you'll see them all there to be able to watch at your leisure. I'm going to approach this in 3 parts. I'm going to look firstly what is aggregation. Then I'm going to have a bit of discussion around the concept, citing a couple of cases. And where I do mention cases, the full references for those appear on a slide at the end of the slide deck. So you'll be able to track them down if you want to see them. And then I'll give a couple of examples in different types of policies. As I say, questions will be at the end, but if you've got them, please do ask them using the Q&A function as you go along, so that they're ready for me to hopefully try and answer at the end before we log off. So aggregation is pretty simple as a concept. It is where 2 or more separate claims covered by a policy are treated as one claim because of some unifying element which links them together. It's a deeming provision generally, which makes them one claim. Now, depending on the circumstances, this can be beneficial for the insured. So for instance, it might mean that there's a limit to the number of deductible payments that might be made. It might be beneficial to the insurer, because you can imagine getting a loss limit, but not facing multiple attritional liabilities where there are multiple claims. But who it benefits is going to be different each time. You may well on one day be wanting the wording to aggregate, and on the next, in a different factual circumstances, wanting it not to. So I think that probably it's useful to use a pretty basic example just to show how this can be pretty significant. If you look at the facts there, you've got a simple circumstance. There's a limit under a policy of £2 million. There is a deductible of £10,000, and facing the insured are 20 claims, each put at around £200,000, so totaling £4 million. Now, if there is some unifying element which, in accordance with the policy wording, aggregates, then the insured is going to pay just one £10,000 deductible, which they may be pleased by, save the insurer will only need to pay their limit, and the insured is going to be potentially uninsured for the balance of something up to £2 million. So probably not the outcome that the insured will want to face. If they do not aggregate, then the insured is at risk of multiple deductible payments, subject to any deductible aggregate, which is a separate issue. And so they could be paying up to £200,000 in deductibles, but the insurer could be on risk for £3.8 million worth of claims, since each individual claim falls well within the limit of £2 million. So in that case, the insurer is going to be less happy. And I think summing it up, there was a quote in one of the Court of Appeal cases I've come to where the court said that how aggregation will affect any particular reinsured is very difficult to predict. But how an aggregation clause will operate in advance is even more unpredictable. I think that's fair, and it's because all of these things arise from the contract. Knowing how it's going to work until you know the facts of any particular case is pretty difficult. So I'm going to come on to some of the concepts and cases. As I say, aggregation arises from the contract itself, and ordinarily there is a deeming provision such that one or more claim aggregate for the purposes of the policy, and it's done normally in 1 or 2 ways. You might have a single event or occurrence clause, where those losses arising out of that single event or occurrence aggregate. And you may have clauses where they arise from the same originating clause. And so I'm going to look at each of those in turn. For event or occurrence clauses, they tend to be more restrictively applied than those dealing with the same originating event. And as you can see in that case of accident field, what's described as something which happens at a particular time, at a particular place, and in a particular way. And what's necessary is something identifiable which is causative of the loss, but not necessarily something which is the proximate cause of that loss. It's less prescriptive than that. But it is necessary that the event is not too remote. And so the way the court often looks at this is using the concept of what it calls the four unities. They're set out on another slide, but they are unities are the cause, locality, time, and intentional motive of human agents to the respective cause. And it's probably best if we actually look at a couple of examples to see how that's been applied. One that a lot of people will know is the case of Kuwait Airways, and it's a pretty useful example. So it arose out of the Iraq War, and at the start of hostilities, 15 aircraft from Kuwait Airways were requisitioned by the Iraqi army from the airport, and therefore there's a claim for the loss of those planes. The claimed loss put it at $692 million, but there was a clause in the policy limiting the liability to $300 million, arising from any one occurrence, any one location. And as I say there, the court aggregated this to a single occurrence because effectively all of the unities were in place: cause, locality, time, and intention. And it's pretty obvious as an outcome because the planes were taken at the same time by the same people from the same place and for the same reason. So the clause probably acted as you would have expected it to. And the court will look at this generally from the perspective of the insured, and they will see whether they involve a degree of unity which justifies them being described as one occurrence, exercising that judgment globally and intuitively. So there's an element of common sense, which is always difficult for certainty. And the Scott case is quite a good, that's mentioned there, is quite a good comparison. So at the same airport, a BA plane was left. It was not taken along with the 15 Kuwaiti planes, but was left on the airport and was subsequently destroyed by coalition bombing. And it was argued that the bombing of various losses at the airport, not the 15 planes, but the bombing, was the same event, and it was concluded that it was not, because the various damage was were not aggregated, since the losses all arose at a different time, in different circumstances, and for different reasons. So there's a comparison which, on the basis of the facts, makes pretty logical sense. And it's quite useful to compare those event and occurrence clauses from those which are the same originating cause. Because these claims are much more widely drawn and are more widely interpreted, but are less commonly seen. So you can see a quote there from the House of Lords in Field. Field was a case which arose out of some unwise underwriting of reinsurance contracts. But the court said that in this type of clause, where there's the same originating clause, there is much less need to find a close causative link. So it's a cause is something altogether less constructed. It can be continuing state of affairs. It could be the absence of something happening. The word originating was consciously chosen to open up the widest possible search for a unifying factor. And I think there was a recent case earlier this year in New Zealand that's just mentioned there, where originating is a particularly important part of the clause, because in that New Zealand case, the absence of the word originating did bring it back to something more like the cause and event policies, where some proximate cause was necessary. And that was a case arising out of some earthquake damage to property. There was, on the facts, an earlier earthquake. The first one caused the later earthquakes, which were effectively aftershocks. And so there was one cause and one limit. I'm now going to turn to some examples from individual types of policies. This is a professional indemnity policy. It's the solicitor's wording, which I suspect is probably known to many of us. And the question that was being addressed in the case that we got there, AIG and Woodman, again, would be known to many of us, arose from a claim against solicitors who'd acted for multiple varying different investors in property development schemes overseas. And the question, looking at the fourth of those bullet points under A, similar action and omissions, in a series of related matters or transactions was whether that series of related matters or transactions if acted such that all of the transactions in which the solicitor acted aggregate with each other, whether in fact it was just each physical development aggregated, so that all the claims relating from development 1 aggregated, but all the claims relating to development 2 aggregated separately, or whether there's no aggregation at all. The Supreme Court rejected the Court of Appeal's decision to effectively try and impose some further wording into the clause. They wanted the relationship to be intrinsic, which doesn't appear in the wording. And the Supreme Court approached it in the normal manner of construction of a contract, and determined that each individual development, so development 1, development 2, any further developments separately aggregated, so there were separate towers of cover. And I think that it's important that the courts are, because this is a contractual issue, the courts are always just going to look at what's there. And in this case in particular, because of course the solicitor's minimum wording, whilst it is a contractual clause, has an underlying statutory scheme behind it. We'll then look at an example that arose from reinsurance. The clause is there, $5 million US per occurrence, but in the annual aggregate separately for flood and earthquake. Now this is a rioting claim, it's not flood and earthquake, so it's just the $5 million per occurrence. And there were 67 separate 67 separate supermarkets were damaged by riots at different locations over different days. And it was suggested that the total riot damage loss was 1 occurrence, since the rioting was said to have been orchestrated by the government. It was held that wasn't the case. There was insufficient unity between the events because they occurred at different locations over a couple of days. And I suspect that that may have been different if this was a same originating cause case, assuming, of course, that there was sufficient evidence to establish the government orchestration of the rioting. My final example before coming on to some conclusions arises from a combined liability policy. Now, it's not a standard aggregation clause in the sense that it's not a deeming provision saying clause 1, claim 1 and claim 2 aggregate because of the unifying factor. This is more of an aggregation arising out of the total amount payable, but it was treated as an aggregation clause. Now, the relevant wording was not defined anywhere in the policy, so the Court of Appeal had to just look at it with its normal approach to construction of the contract. And one of the interesting things is it emphasised that it did not approach an aggregation clause with any predisposition as to whether the approach should be narrowed or should be widened. They simply approached it as a matter of construction. And the effect in this case was that several hundred negligence claims brought against several hospitals were aggregated to a limit of £10 million instead of the annual aggregate cap, which would have been in place of £20 million. I'm going to turn to some conclusions before looking at any questions, because I think we're coming up to about a quarter of an hour. And I think it is really important, as hopefully I've stressed, that it's a matter of aggregation is a matter arising from the contract, and the rules of construction apply. So depending on your position, you are likely to want to aggregate on one matter, but with the same wording to resist it in the next. Depending on where you are in the overall transaction. And if you recall the very basic example that we had at the beginning, the insured is in one circumstance massively underinsured, but in the other, the insurer is paying out way more than their limit. So these are matters of really big significance. And as such, they can lead to challenges from many different parties. So, there's challenges from an insured to their insurer, from claimants in a third-party claim, and there's loads of scope for arguments as between primary and top-up layers, and between insurers and their reinsurers. And as in all matters, you need to work quite hard in terms of getting the evidence together to identify and evidence the unifying factor you're relying on. And it's quite possible that in these types of claims that people take a decision for tactical reasons, being prepared to have a fight with a view to a commercial resolution. I think that what's important is that there is no right answer in this. And just repeating the quote I mentioned earlier, how aggregation will affect any particular reinsured is very difficult to predict. how an aggregation clause will operate in advance is even more unpredictable. So having done about 15 minutes, I'm going to hand over to Harriet to share any questions which you may have given before we come to a conclusion. Harriet?
Thank you very much, Neil. I do have two questions to ask you, and there's a bit of overlap between the two of them, but I'll start with the first. Do you think that the COVID pandemic is capable of being an aggregating factor? And if so, are you able to illustrate in what way?
I think the answer, particularly with COVID, but as I've said, hopefully I've covered myself enough that there is no right answer, which is always useful before answering questions. But I think it's pretty difficult to tell at the moment. Certainly, a very large-scale event such as hurricanes, earthquakes, that type of thing, can be a cause that is unifying. So I suppose a pandemic could be, but I thought it's pretty unlikely that there's going to be sufficient proximate cause that the pandemic is. Where I suspect it's probably more likely is around the impositions that's been placed on all of us in terms of restrictions of movement, shutting businesses. You can imagine that the guidance that we're having to follow, so the COVID Act and the regulations from government restricting what we can do may well be more likely to amount to something which is a potentially unifying factor. And certainly, I mean, there are some cases in relation to the Twin Towers and terrorism where government guidance has been accepted as potentially unifying. Where I suspect, so I think it could be, if you identify very carefully what it is. And we've obviously got to wait and see in terms of what cover is in place anyway, arising from COVID, what's happening in the FCA case at the moment. And I think aren't there arguments that there may be physical damage aspects, that people with the virus come along, touch a surface, which makes that which makes that potentially something that infects others, and so you've got some physical damage there. So I suspect it's possible. Where I can think it might arise is clearly if business interruption covers it, as to which we don't know, then there may be some reinsurance issues over that in terms of aggregation. Holiday covers, those might be there. I suspect that's probably where it's most likely to arise. Yeah, I think, but it's potential, but I think watch this space.
Thank you very much indeed. One of the questions that has come in has probably crossed over with the question I've just asked you. But what they have asked, and it's an anonymous attendee, is whether you have any comment on insurers' hopes to aggregate certain claims relating to COVID, which you may or may not choose to answer.
I think all I can say at the moment is it's too early to tell. I think there is certainly a legitimate argument there. I think that's probably as far as I can go. It is still a moving circumstance. We don't know what's in fact going to be triggered. I think maybe we can come back to this after we know what's going on, for instance, in the FCA case.
Thank you very much, Neil. We have no further questions, so I'll pass back to you.
Thank you. Thank you very much. I hope that was useful for everybody. If there are any questions we haven't been able to answer, then please do feel free to connect on LinkedIn, ask or drop an email on the website. Please do provide any feedback as to what you thought, including letting us know anything else that might be of interest to add to the series. We think it's been quite well received, and we'd like to put on anything else that you might like. I do invite you to join my colleague Stuart Lloyd from our London office, who's doing the webinar next week. He's discussing illegality. I'm going to move on in a second, but the next slide, which I won't trouble you with, when you get the slides, has all of the material, all the case references on it, so you've got them there. But otherwise, I will say thank you very much. We will end the recording in a second, but we will stay on just to allow some opportunity for you to provide feedback. Enjoy the rest of your day, and I hope your children and pets weren't too noisy. We didn't hear them. Thank you.